Welcome to The Explainer. So you're trying to cut through all the financial noise out there, right? You want to see exactly how different investments actually perform in the real world. Well, you are absolutely in the right place. Today, we're breaking down this really fascinating experiment where $800 was divided up across 8 popular investment types. We're going to see what actually works, and honestly, what totally doesn't.
Let's kick things off with a question. If you took $100 and invested it into 8 entirely different vehicles, how much would you actually make in just a month and a half? Our source material follows a financial expert named Mark who did exactly this. He tested the market with his own hard-earned money, and then, this is the cool part, he brought in a complete beginner named Tom. Tom had zero investing experience. The challenge? Seeing if Tom could use Mark's real-world data to build his very first investment portfolio from scratch.
So here's our roadmap for today. We're going to start with the setup, move into playing it safe, check out the wildcards, tally up those final results, and finish off with that beginner portfolio. Let's go.
Starting off with Section 1, the setup. This is where the real-world financial stress test actually begins. Moving right into Section 2, playing it safe, we're going to look at the lower risk options first.
Okay, so these first foundational investments, they're pretty much considered the bedrock for everyday folks trying to secure their financial futures. First up, a high-yield savings account. The return? A whopping 4 cents in profit? Yeah, I know. It seems completely pointless, right? But the source stresses that this isn't actually about making money. It's about having a solid 4 to 5 month emergency backup fund, so you don't have to take out some crazy high-interest loan when, say, your car suddenly breaks down. Now, the second investment was gold, which actually lost 98 cents. But wait, gold is traditionally an inflation hedge. And get this incredible stat? The US dollar has actually lost 95% of its value since 1913. So generally speaking, as the dollar goes down, gold goes up, keeping your overall purchasing power relatively safe over the long haul. Let's look at our third safe investment, the index fund. Basically, this is a low-risk, passively managed fund that tracks a broader market. In this experiment, $100 went into a Vanguard S&P 500 ETF, which tracks the top 500 companies in the US, heavy hitters like Amazon, Apple, and Tesla. The result was a safe, steady $1.84 profit in just a month and a half. And because it's passively managed, meaning you don't have high-priced experts day trading it constantly, the fees are super low. It's an absolute staple for long-term growth. Actually, there's a brilliant analogy from the source that explains exactly why index funds are so highly recommended. Think of owning a single stock like owning one cow. If that cow gets sick and dies, well, you have no milk. You lose everything. But owning an index fund? That's like owning a tiny piece of the entire herd. If one cow dies, the rest of the herd just keeps on producing, and it barely even makes a dent in your overall portfolio. It's all about spreading out that risk. All right, the fourth and final safe investment they tested was a REIT, or Real Estate Investment Trust. This is a way to invest in commercial properties like office buildings or hotels without having to, actually go out and buy a whole building. In the experiment, the physical value of the REIT dropped by 40 cents, but it paid out a 57-cent dividend. So that dividend actually left the experiment with an 11-cent total profit. So the real takeaway here is just how accessible a REIT makes real estate investing. Instead of trying to scrape together hundreds of thousands of dollars to buy a house all by yourself, a REIT lets you pool your cash with other people. It's kind of like one person owning the front door, you own a window, and maybe someone else owns a few bricks. But because commercial properties sign those long, secure leases, everyone gets to share a piece of the rent that comes in, which is paid out to you as dividends. Pretty smart, right?
Now for Section 3, the wildcards. This is high-risk, high-reward territory. This is where we completely leave the safety of the herd and jump into a world where volatility absolutely rules. Investment number 5 brought in a massive profit of $67.87. How? Just good old-fashioned business buying and selling. Mark actually used his personal market knowledge to scour eBay. He found a mispriced model engine and an airplane, bought them for $100 and flipped them for a huge margin. The catch, of course, is that this requires active effort and very specialized knowledge. If you happen to know the exact value of, say, vintage Star Wars toys, you can spot deals that everyone else totally misses, which means your risk level drops way down if you actually know what you're doing.
Investment number 6 was an individual stock. But here's the crazy part. Mark didn't analyze the market at all. He literally threw a dart at a board of 20 companies while blindfolded. It landed on Samsung, and purely by sheer luck, it returned a profit of $19.43. Now, obviously, While luck played a massive role in this specific test, the source quickly reminds us that throwing darts is definitely not a real financial strategy. If you're going to invest in individual stocks, the actual way to do it is through fundamental analysis. Studying financial statements, balance sheets, and company leadership using tools like Yahoo's Finance.
Okay, let's move to investment 7 and see how this builds out our high reward picture. $100 was put into Bitcoin, and in just a month and a half, it returned 98 bucks. That is a staggering 98% return. The source highlights that Bitcoin appeals to a lot of folks because it's decentralized, meaning it's not controlled by any government or bank. Plus, unlike the US dollar, which is constantly getting printed, Bitcoin has a strictly limited supply. In fact, all the Bitcoin that will ever exist is currently being mined, and that process isn't expected to finish until sometime in the 22nd century.
But we really have to hit pause here and look at the dark side of that 98% crypto profit, and that's extreme volatility. The source strongly cautions that Bitcoin's value swings violently. Just to give you some context, look at this. On December 17, 2017, a single Bitcoin was worth over $20,000. Just 1 week later, December 24th, it plummeted down to under $14,000. It is literally the definition of a win or lose situation.
And finally, our 8th investment was just a pure gamble. Lotto scratch cards. The $100 instantly lost half its value, returning a devastating $50 loss. We're talking a 10 out of 10 on the risk scale here. The source shares a rather sad statistic about this, actually. Despite the really obvious math, 50% of Americans engage in this high-risk gamble every single year, just hoping for that exciting big win that, let's be honest, almost never comes.
All right, Section 4, final results. Let's tally up this whole experiment. Let's bring all this data together before we hand the reins over to our beginner, Tom. When you line up all 8 investments side by side, the contrast is just stark. On one end of the spectrum, you have the slow, steady, highly reliable returns of index funds and REITs. And then on the other end, you have the chaotic, extreme swings of crypto and lotto cards. Now, the active hustle of buying and selling, that generated great returns, but it demanded the most specialized knowledge.
So, what was the grand total? That initial $800 generated a combined profit of $108. That is an 11% growth rate. To put that into perspective for a second, a 10% return is considered a fantastic average growth rate for an entire year. So hitting 11% in just a month and a half across a totally diverse, somewhat random portfolio, that is an incredible result.
Moving into Section 5, Beginner Portfolio. Let's see how Tom handled this. This is the application phase. Mark hands $800 in real money to Tom, who, remember, has never invested a dime before in his life, and tells him to allocate it using only the data we just went over. Let's walk through his real-time thought process. First off, he immediately rejected the low profit and loss options, totally skipping the savings account, gold, and REITs. Second, he decided he really wanted a foundation of steady growth, so he opted into the S&P 500 index fund. Third, looking at the wild success of that random dart throw, he decided to pick specific individual stocks, but went with ones he actually believed in. And finally, he decided to take a calculated risk for high reward, skipping those awful lotto tickets but opting for cryptocurrency. And here is Tom's final $800 allocation. He put half his money, $400, into individual tech stocks, specifically Tesla and Google. He took $200 and bought a piece of the herd, putting it into the safe Vanguard S&P 500. And finally, he took his last $200 and just embraced the volatility, throwing it right into Bitcoin. It's a pretty aggressive, targeted portfolio for a beginner, but it was built entirely off the real-world data from the experiment. As we wrap this up, I want to highlight an incredibly empowering quote from the source material. We so often think investing requires massive sums of money to even get started. But the source points out that if you invest just $100 a month at an 8% annual growth rate, over 45 years, you would have over $500,000. That $100, it can be found just by cutting out a few coffees or maybe picking up a small side hustle. It's those small, consistent shifts in our everyday habits that create massive long-term wealth. Which leads us perfectly to our final question for you. Having seen the slow and steady safety of the index funds, the active hustle required for buying and selling, and the chaotic roller coaster that is crypto, if someone handed you $800 today, how would you allocate it? Would you follow Tom's aggressive tech-heavy strategy, or would you play it a little closer to the chest? Think about it. Let this real-world data be the spark that kickstarts your own financial journey. Thanks so much for joining me for this explainer.